this episode of The Wealth Creators, we are focusing on the business of wealth management. India's superior economic growth is leading to a very sharp increase in financialization in India and leading to further higher increase in the number of HNI and affluent investing class in India. And one of the companies which is doing phenomenal work in the area of wealth management is Nuvama. And today I am right here in the headquarters of Nuvama Wealth Management in conversation with Ashish Kehair, the MD and CEO. Ashish, good to invite us and thanks very much for joining us on this special episode of The Wealth Creators.
My pleasure.
Well, wealth creating is your full-time job, but I've been observing the way when the company was born as a demerged out of Edelweiss and now an independent entity. Then we saw how global private equity and wealth management companies picked up stake, PAG. That was the origin of the company, and now you are independently running this, leading this company. Several quarters of earnings have gone by. I want to start discussion on wealth management as a business in India. What we are witnessing, of course, high growth in your numbers, but the HNI population and the investing class in India is also witnessing very high growth, 12-13%, highest compared to some of the biggest economies anywhere else in the world. Do you see this as structural change, and do you see big tailwinds behind this phenomena?
Absolutely. I think as our GDP grows, companies do well, real estate does well, and ultimately this creates the prosperity in the hands of individuals. And this prosperity we are clearly seeing is now spreading out, what we call democratization. It's going beyond the top tier cities, and coupled with that you also are seeing financialization. So when you mix these two things, I think it's a structural trend, and to my mind it's just started. And if you see globally, in many of the countries, the large service providers for wealth management are banks. But in India, we are in a unique spot where our credit needs are also very large and our wealth management needs are also very large. So banks actually focus more on credit, and that leaves that space fully available to wealth managers like us.
That's interesting, because I just saw the recent deal of Credit Suisse, and what we are observing is that globally, banks are actually deriving bulk of their value from their wealth management businesses. So they are actually getting better valuations because of the wealth management part of it. What is the landscape looking like? How long do you think a structural tailwind kind of a horizon can we see for wealth management as a space? It's an early nascent stage. We've had conversations about how tier 2, tier 3 India was never serviced on wealth management side. It was just the banks perhaps doing added service. How all of that changing?
See, if you look at the whole pyramid, there are actually two dimensions, right? One dimension you said is the geographical dimension. So that dimension is opening up where things are moving beyond tier 1 to, let's say, a tier 2, tier 3, tier 4. And again, I am saying as your per capita GDP moves, this increase will keep happening. And second is, if you look at the pyramid from a affluence lens, there is what we call the super rich or the ultra high net worth, then there are high net worth, then there is affluent, then retail. Right now, the size of wealth or the size of assets, which let's say each of the constituents of these pyramids have, it makes it economically profitable for people to operate in, let's say, top 2 tiers. The explosion which will happen once you move from whatever per capita GDP you are right now to say a 10,000.
Say 2,800, 2,500 thereabout.
Which is
when
now
it goes to 10,000.
10,000. Even your bottom of the pyramid starts becoming attractive. Because the economic affluence which they have, the disposable investable surplus which they will have, will start making this business profitable. So you see the structural growth is not only geographical, it's also people going down the pyramid over a long period of time.
Okay, so you have always differentiated your business model that you are not only focusing on the top tier metros which are over-serviced and competitive intensity is very high, but you want to go the B30 way, as mutual funds like to describe themselves, beyond the top cities. Which are the areas where you're seeing good promise, you're actually increasing feet on ground, etc.?
So these are typical cities which have businesses which have been existing. I mean Jaipur, Udaipur, Dehradun, Varanasi, Coimbatore, Trichy. See that these will not figure in your tier 1, but these have thriving businesses. Many of these cities now have listed companies there.
Yeah.
So they also have people with ESOPs there. Earlier, your salaried employees were largely concentrated in tier 1.
Yeah.
Right? If you look at IT and banking, financial services, yes, there are bank branches, but all headquarters were in tier 1. But now you're seeing even corporate headquarters going to these cities. So that expansion is happening. And the second differentiation we always keep doing is that we don't normally operate only in that ultra high net worth space. We also operate in mid market, which is vast and unserviced.
So let's talk about your business model, how you're differentiating it. I saw roughly 2,000 crore is what you're clocking right now on the revenue front. What is the breakup and which revenues, which segment is the highest growth right now and contributor also to your top
So
line?
see, predominantly we look at ourselves as a wealth management company, right? So today 60 to 65% comes from between wealth and asset management, and that is a segment which is our focus segment for us. Then we also have some capital market business. We have custody clearing business. Custody clearing is also growing well. And capital markets, we have the investment bank and institutional equities, which is also playing on the India story in a sense. Wealth is playing on the household side, and capital market, one part like an investment bank, is also playing on the promoter side, which coincides with our ultra high net worth business, and institutional equities is playing on the India growth story. So in a sense, the whole play is on India, but focus is on wealth, and we use all the other pieces to sort of support the wealth management and its growth.
So, the fear or one of the concerns when I talk to people is that the business model of a wealth management company is highly correlated with the stock market, outlook. But when we actually look deeper, the correlation on the upper side is relatively higher, and the correlation on the downside, suppose we grow at a 12 to 15% CAGR on, say, markets for next 5-6 years. Then what is the multiplier for your revenue growth? How much higher? And if we actually go in a smaller, somber range on the downside, how is the multiplier? How is that cushioned because of the diversified revenue mix?
See, a simplistic way of looking at this is, let's say if your equities were to grow by 15%, which is like a doubling in a 5-year period, then you add the flows, new flows which come from the same clients. So that is about 8-9% a year. So that's about 24%. And if you take debt growth, let's say at 8%, and new flows at 4-5% there, so that's about 12-15%. And blended asset allocation of clients is say 50-50, then your assets are growing at around 20%. So you're at so if your markets in a sense is growing by 15, you can grow by 20.
Okay.
On the downside, what happens for players like who are in wealth management, they're slightly better protected. So as I keep saying that if you're only into broking, you're closest to stock market.
Sure.
If you're in traditional asset management, which is your mutual funds where more than 90% of your profitability is driven from equities, you're slightly distant next to broking. And if you're then wealth management, you're the third one. So your degree of separation is the farthest, but yes, all these players will be correlated to the stock market.
But is it fine to assume that if one were to play the economic growth story and capital market growth story, then perhaps the most risk adjusted way is to play the wealth management stocks?
So you will not get that super high beta also,
but
at the downside you will be protected. And in investing, it is clear that if you protect yourself on the downsides more, the upside takes care of itself.
Yes, so true. Okay, let's talk about your growth, since we are talking about growth. Somebody was telling me that to a lot degree wealth management growth is like domestic pharma, right? One is that you have to keep launching new products, OTC products, which are high growth, and then the other side is more feet on street in terms of RMs. You also have RMs, domestic pharma also has RM. You have to go after newer clients and also put a lot of army of RMs. What is your growth strategy from here on?
So I think slightly, I would say similar, but some differences. Like you do not need a slurry of new products in wealth management.
Sure.
You may need one or two in order to capture certain asset class or certain risk spectrum which is not traditionally solved by the products which are existing in the market. And it also gives you an edge as a firm to engage with the client if you keep innovating on the product edge, but you don't require.
The focus is not actually the manufacturing.
The focus is actually sourcing the right manufacturing. What you can manufacture, you also manufacture, but you should be able to source the right manufacturer in order to give the client the most optimal risk-adjusted return in any asset class. Feet on street, I think, is similar. Yes, your current feet on street productivity will also grow because this business is a business where client itself keeps on growing. If a client does nothing, adds no new flows, even then their assets double in 6-7 years, right, by sheer compounding. So in that sense, the same client grows, the same client adds new flows, so your current RM becomes more productive, and then you keep adding new RMs who reach the desired level of productivity in, let's say, 3 to 5 years, and you keep adding.
So how many RMs do we have right now, and what's the plan to take it higher by 3 years?
So in Nuvama Private, we will have about 120, 125, and Nuvama Wealth, which is our mid-market, we now have order of magnitude 1200.
That's a big number.
That's a big number. We want to continue to add 20-25% in both every year, maybe more in Nuvama Wealth.
Okay.
And till the time we are able to absorb them, train them, and take them to the level of productivity, I don't think we will stop, because if you look at the numbers which the country can take versus what we have,
the demand supply gap is very hard. So in the next 10 years, we are talking about 12,000.
It can.
RMs.
It's difficult to visualize now, but if you go back and see in history, if you look at, countries like US where these businesses have transitioned over the last 20 years, we are maybe 20 years behind. Those are the kind of numbers with which people operate.
So we've spoken about the growth part of it coming purely by new business. How's your existing business growing?
So that's what I've said. Any existing, the beauty of this business is that this is not consumed, right? This keeps adding. Your equity portfolio, your mutual fund portfolio, your PMS portfolio, your debt portfolio as a client keeps compounding.
And your costs are not actually rising the same
proportion. Costs will also rise, but it will not rise in the same proportion, because for example, this head office is not going to get added, right? This is fixed. All your support functions, your technology costs will not rise at the same pace. So your only cost that is moving is your producer cost, which is a proportion of your total cost.
How's your cost to income right now, and where do you see it sustain?
So we are right now maybe order of magnitude 63-64%. 63% is where we ended the year. We want to reach anywhere between 59-60 in the next 2 to 3 years. That's where we want to target. Then we will see the next phase on where to go.
Ashish, we just saw the announcement recently that you guys are interested in setting up an office in Dubai as well. One is getting a sense that now not only is India your focus, but you want to channelize funds from the rest of the world, be it NRIs or investors interested to park money here. What is the strategy there?
See, going offshore basically will serve 3 purposes for us. One, yes, the most obvious is to channelize the NRI interest, which is now increasing in India. As our market cap is going up, once we become a $5 trillion market cap, they say a country becomes an asset class. That's the mark, and we are near that.
So India is clearly becoming an asset class in itself.
So global allocations will come, the interest will come. It will no longer remain a yo-yo market. Come and go market. It becomes a mainstream allocation. So you want to capture that. Second, as we are seeing the domestic affluence going up, many of the large families, they want to have one leg outside. And I think in that sense, Middle East or Dubai and both Abu Dhabi have done a decent job in creating an infrastructure which is attractive for family offices to set up, to invest globally from there. I think Gift City will also happen. Over a period of time, it will evolve and become a compelling alternative.
And you do have office there?
We do have an office, and we are closely working with the authorities to make it, evolve it really fast. But as of now, I think Dubai serves that purpose. And so this is one leg. So India to offshore for family offices, Indian wanting to invest offshore, money coming from there, and we'll also serve the local needs of the NRI client. So I think it's an expansion of a market, and once we are able to establish ourselves in that market, understand the game, we may be then looking at other markets also.
So tell us, what are the growth levers you have? One is geographical expansion. The other is more feet on street.
Correct.
And you already obviously have a very wide, array of bouquet of products. What else are you? How are you? What is the strategy on growth? Because you have tasted, given the taste to the investors, 30% revenue growth, 50-60% profit growth. So what are the levers you are pressing now to ensure it sustains?
I think largely these are the two levers in our business. If you see, even when we have grown in the past, these are the two growth levers we have exercised, because our product platform is well built. Of course, there will be innovation on the product platform continuously. That's a journey that can never stop in this business. You will keep on adding. Asset management is one business which will expand, which is right now not contributing to profitability.
I'm told you're also incubating a AMC within.
Not a mutual fund. We are more alternatives.
Alternatives.
We have about 8,000 crores or $1 billion of AUM, which we have raised over the last year. We have a private equity practice. We have a hedge fund practice, and we've launched a commercial real estate practice. So we will continue to expand these and look at new strategies. So that will bring in growth, and profitability growth will also come from operating leverage. So I think these are the levers which will continue to drive growth. Offshore right now we've added, but I don't think it will become a large meaningful contributor, at least for the next 2 years, because it's just one geography. Once we see how that plays out, how the diaspora reacts, how the flows are working, I think then we'll be able to make a better bet.
Also, talk to us a little bit about the importance of people, because human capital is, the strategic capital in your line of work. You have a very large workforce, 12,000 RMs, 1,200 RMs. I'm sure it will reach 12,000 as well, and 100 on the other business, 1,300 RMs. The importance of people and how you really keep them, very excited about work and stuff like that, because then otherwise, if they are not efficient, they're the direct impact on the growth, right?
Absolutely. I think people who come to work in the area of wealth management, in my view, necessarily have to have an interest in investing and markets. If people come to this space just like another job, I don't think they will sustain or excel, because this is a business where you have to be on top of the markets all the time, and a wealth manager, unlike an asset manager, has to know about all the asset classes, because the client can ask him about anything and everything. It could be.
So you need to cultivate knowledge culture as well?
You need to cultivate knowledge culture. You need to get people who have an inherent interest in investing, and then you need to create a platform which is a client-friendly business, because this business, if you see, in all of financial services, is something which I think is the highest value add in terms of, let's look at a mid-market client. If you are able to create financial independence for somebody as a firm, you are actually doing a job which is very high up in the hierarchy of financial needs, right? If you are able to imbibe that culture in people, execution excellence, fairness towards customers, I think it automatically excites
and
them.
Proper incentive.
Proper
culture,
incentive.
of course.
So that I'm saying is hygiene.
Yeah, that's hygiene.
That's hygiene that any firm will give. That without that you can't exist. I mean, if you don't have that, you lose everybody. But that is hygiene. You have to do beyond that in order to excel in this business. If your culture is not client friendly, if your culture is of not thinking of long-term client success, you will not have a very lasting business in this. This is a business where you have to think, can the client outlive me as an individual?
I was checking out your shareholding pattern. I saw half a dozen mutual funds, some very prominent, PMSs have come in, and of course your previous shareholders. But there is also, a big chunk of stock from, the previous one that Edelweiss still holds. When is that lock-in actually ending?
I think this is a lock-in which will end this September, because we got listed in September. So any entity which held our shares before the demerger was locked in. Sure. Even if an employee would have held, he would be locked in at least for 12 months. Anybody who got post the demerger is not under lock-in. So that will end in September.
Right. So just to end our conversation, Ashish, anybody among our viewers who's a shareholder, etc., watching this conversation and interaction right now, can you share fair degree of optimism and certainty about the trajectory of growth, at least in the medium term, not very short term, but the effort which you are taking, the environment you're operating in, does it give you 2-3 year visibility on 30% kind of a growth on top line?
See, we don't give guidance on
Sure.
growth, but all I'm saying is that we are working, first of all, in a country where nominal GDP growth itself you are seeing is where it is. And if that continues to happen, I would presume that the profitabilities of companies, businesses will do well in general, which augurs well for us. And this is as a space, wealth management space. Our fundamental principle is that 10% come by flows, another 10% come by way of mark to market. If you add that, then 20% growth in AUM. There are years like this where you have seen 50%.
Sure.
There will be years where you will see minus 10 also.
But average
on
is
an average, 20% in a state where we are in India looks visible to me. I mean, you
But
look
the
at
point which you're making about operating leverage, I want to scratch that a little more. That actually best of operating leverage sitting here today actually starts coming in year 3.
Yeah.
Which is, we are talking about FY28 is when, because you're going, the massive amount of addition on RM front is actually happening now.
So as your new RM to old RM ratio keeps coming down, your degree of operating leverage keeps coming down because you scaled.
What is the ratio right now?
So right now, if we hire, let's say next year, maybe 300 people on a base of say 1250, 1300, so it's almost 25% addition. Maybe 3 years out, that will become 15%. So as and when you go that, your drag keeps coming down and your operating leverage keeps.
So in the next 12 months, you are aiming at hiring 25% higher.
20 to 25% is what we are aiming at.
Lovely. Great interacting, Ashish. Thank you so much for your time and explaining your business model. And it was great to interact with you on Wealth Creators. Thank you so much for your time.
Thank you for having me here.
Great.
Thank you.
Great.